The global oil reset has begun, and despite the way it is framed in headlines and political commentary, this is not primarily a political event. It is not a reactionary move, not a temporary disruption, and not a short-lived crisis that will resolve itself once attention shifts elsewhere. What is unfolding is structural in nature, systemic in scope, and irreversible in consequence. It represents a reordering of how oil is controlled, produced, distributed, and ultimately priced within the global economy. While the trigger appears geographic and immediate, the effects are diffuse and long-lasting, rippling through energy markets, financial systems, trade relationships, and power hierarchies worldwide. This is not an intervention designed to manage a moment. It is the opening phase of a reset designed to reshape the system itself. At first glance, the event appears dramatic, sudden, and overtly geopolitical. The United States moves into Venezuela, a country that holds the largest proven oil reserves on Earth, and the world responds with alarm, speculation, and ideological debate. Commentators frame it as escalation, provocation, or confrontation. But beneath that surface-level drama lies a much deeper mechanism that has little to do with personalities or rhetoric. Oil is not merely another commodity subject to supply and demand like copper or wheat. It is the base layer of the modern economic system. It determines the cost of moving goods, the price of food, the margins of manufacturing, and the trajectory of inflation itself. Because oil is embedded into nearly every economic process, any meaningful shift in who controls its supply and how it flows through the system constitutes a global shock by definition. This is why the phrase global oil reset is not hyperbole. It is descriptive. When control over oil changes, everything else follows. Transportation costs recalibrate, trade balances shift, inflation dynamics evolve, fiscal assumptions break, monetary policy constraints tighten or loosen. Energy is not a sector of the economy. It is the infrastructure beneath the economy. To misunderstand this is to misunderstand the significance of what is now unfolding. Venezuela occupies one of the most paradoxical positions in modern economic history. On paper, it should be one of the most powerful energy nations on the planet. Its proven reserves exceed those of Saudi Arabia and dwarf those of the United States. Yet for decades, Venezuela has functioned not as an energy superpower, but as a broken asset. Its oil wealth has remained largely dormant, trapped beneath collapsing infrastructure, outdated technology, institutional decay, and international isolation. Markets have struggled to price this contradiction accurately because geological abundance has been disconnected from operational reality. Oil that cannot be efficiently extracted, refined, transported, and sold at scale does not confer power. It is unrealized potential, and unrealized potential attracts intervention. The critical shift now underway is not simply that the United States has reasserted influence over Venezuelan territory. The deeper change is that the structural bottlenecks preventing Venezuelan oil from fully re-entering global markets are being targeted directly. Infrastructure, logistics, refineries, pipelines, corporate access, and capital flows are the true levers of this reset. Once these levers begin to move, oil markets do not adjust slowly. They recalibrate. Increased production capacity alters supply expectations. Expectations move futures markets. Futures drive prices. Prices propagate through the entire economic system. This is where the concept of an energy war becomes unavoidable. Modern energy wars are not fought primarily with tanks or missiles. They are fought through contracts, sanctions, access rights, shipping lanes, financing channels, and technological capability. Control over Venezuelan oil is not just about extracting value from the ground. It is about denying access to rivals, reshaping trade routes, and reasserting dominance over a resource that underpins global growth. Venezuela is not the endgame in this process. It is the lever. Markets are not reacting to what has already happened. They are reacting to what is now possible. If American oil companies regain access, If production capacity is restored incrementally, and if Venezuelan supply begins to rise meaningfully under U.S. operational oversight, the long-term implication is straightforward: downward pressure on oil prices. But markets never move in straight lines. Before increased supply stabilizes prices, uncertainty dominates. Geopolitical tension injects fear. Fear breeds volatility. Volatility is not a side effect of resets. It is the mechanism through which resets occur. This is why the early stages of the oil reset appear chaotic, contradictory, and emotionally charged. It is not disorder. It is transition. Oil price movements never remain confined to the energy sector. They flow immediately into shipping costs, logistics, consumer goods, industrial inputs, and household budgets. A change in Venezuelan output does not stay within Venezuelan borders. It transmits across the system. Investors, governments, and institutions understand this. They are not focused on Venezuela itself. They are focused on the cascade. What makes this moment particularly significant is timing. The global economy is already structurally fragile. Debt levels are elevated across both developed and emerging markets. Central banks are constrained by political pressure, credibility concerns, and the lagged effects of past tightening. Supply chains, though stabilized relative to crisis peaks, remain vulnerable to disruption. In this environment, a major energy realignment acts as an accelerant. It speeds up trends already underway, forces repricing across asset classes, exposes weak balance sheets, and rewards those who understand structural forces rather than headline narratives. This is not the conclusion of an adjustment. It is the beginning of one. The oil market is being repositioned, and with it, the balance of economic power is shifting. The noise focuses on leadership and politics, but the substance lies in control over energy flows in a multipolar world. Who absorbs the shock, who benefits from the reset, and who loses leverage will determine the next phase of global economic alignment. To understand why Venezuela sits at the center of this reset, one must confront the reality of its structural decay. Venezuela does not lack oil. It lacks operational capacity. Power in energy markets does not come from reserves alone. It comes from extraction efficiency, refining reliability, transportation consistency, and sales scale. Venezuela lost these capabilities long before the current moment. The roots trace back to the nationalization of the oil industry, when foreign operators were expelled, capital fled, and technical expertise evaporated. What remained were vast reserves paired with declining output. For a time, high global oil prices masked the damage. Inefficient systems can still generate revenue when prices are elevated, but without reinvestment, decay accelerates. Infrastructure corrodes, pipelines leak, refineries fail, skilled engineers migrate. Production falls not because oil disappears, but because the machinery of extraction collapses. Sanctions compounded the problem by cutting off financing, equipment imports, and technical partnerships. Venezuela became dependent on buyers willing to tolerate inefficiency in exchange for discounts. China stepped into this vacuum, not to rebuild Venezuela's oil industry, but to secure discounted supply. This relationship sustained minimal output, but did nothing to reverse long-term decline. Venezuela became a supplier of cheap barrels rather than a competitive producer. In market terms, it became the most powerful broken asset in the global energy system. Broken assets attract intervention because they represent unrealized value. From a market perspective, Venezuela's reserves have always been mispriced because the constraints were political and technical rather than geological. Once those constraints are challenged, repricing becomes inevitable. This is the logic driving the current shift. The focus is no longer ideological, it is mechanical. Restoring flow is not about symbolism, it is about capacity. American oil companies do not enter markets for charity. They enter when the mathematics align. Venezuela represents one of the most asymmetric opportunities in global energy. Compared to the cost of developing new fields elsewhere, Rehabilitating existing Venezuelan infrastructure offers massive upside. Historically, Venezuela produced over 3 million barrels per day. Today, it produces a fraction of that. The gap between potential and reality represents millions of barrels the market has effectively written off. Reintroducing even part of that supply alters global dynamics. This is why Venezuela's condition matters globally. It is not about current production. It is about potential. When a country cannot monetize its own resources, it loses leverage. Control migrates toward those who can restore functionality. In this sense, Venezuelan oil has already ceased to be purely a national asset. It is a strategic variable in a global contest over energy dominance. Markets recognize this pattern. They have seen it before. When constrained producers re-enter, volatility spikes first, then direction emerges. Risk is priced before output. That risk includes political instability, operational delays, and backlash from displaced partners. But it also includes opportunity. The moment markets believe Venezuelan oil is no longer permanently stranded, expectations shift. Expectations are the first stage of every reset. This is why the story cannot be reduced to intervention or leadership. It is about dormant capacity being reactivated under new management. Once that process begins, it rarely stops quietly. Supply chains realign, contracts change hands, buyers adjust strategies, rivals respond. The oil market absorbs a new reality. The economic logic driving U.S. involvement reveals itself through language. The focus is on infrastructure, output, reimbursement, and capacity. This is not ideological framing. It is operational framing. The objective is dominance over marginal supply. In oil markets, marginal supply determines price direction. Venezuela represents one of the largest pools of marginal supply on Earth. Increasing production is not about maximizing Venezuelan income alone. It is about reshaping the global supply curve. Even modest increases matter. A few 100,000 barrels per day pressure prices weaken cartel leverage and alter forecasts. In a world of slowing demand growth, additional supply amplifies downside risk. This also serves domestic objectives. Energy prices influence inflation. Lower oil prices ease transportation costs, reduce consumer pressure, and give policymakers flexibility. In an era where central banks are constrained, energy becomes an indirect macroeconomic lever. This is why the oil reset aligns with broader economic strategy. Volatility plays a role here. Short-term shocks flush speculative excess, reset positioning, and reprice risk. Energy markets overshoot by design. Turbulence is not a failure. It is part of the process. As uncertainty rises, capital rotates. Weak positions unwind. By the time production increases materially, the market structure has already changed. This also shifts dynamics with other producers. The mere possibility of Venezuelan supply returning weakens coordinated restraint. Latent capacity disciplines markets by existing. Venezuela becomes a deterrent as much as a supplier. This move also signals something broader. Resource ownership without operational capability is no longer sufficient. Energy sovereignty becomes conditional on execution. Control follows those who can extract, refine, and distribute at scale. Markets internalize this quickly. China feels this shift most acutely. For years, it benefited from Venezuela's isolation. It secured discounted supply, diversified imports, and expanded influence. But this access was contingent on Venezuela remaining broken. Once reactivation begins under U.S. influence, China's advantage erodes. Control over infrastructure determines priority. China shifts from preferred buyer to displaced participant. This loss tightens margins and reduces flexibility. It does not cause collapse, but it compresses strategic space. In a slowing economy, marginal losses matter. Venezuela was a symbol of China's ability to convert Western withdrawal into gain. Reversing that outcome sends a signal far beyond Latin America. Energy access is a strategic lever. Losing it forces adjustments elsewhere. Costs rise, negotiating positions weaken. This confrontation remains indirect because indirect pressure is more effective. Energy flows reshape outcomes quietly. Volatility expresses this conflict. Oil markets price anticipation. Leverage magnifies emotion. Spikes and reversals reflect uncertainty about future supply. Fear-driven rallies coexist with structurally bearish pressure. This whipsaw environment punishes rigidity and rewards adaptability. Over time, structure asserts itself. Expanded supply undermines scarcity narratives. Price expectations shift. The reset creates a new baseline where pricing power is less secure and supply more contestable. This redistributes power from producers to consumers. Oil influences money. Energy costs shape inflation more directly than most policy tools. Expanding supply eases pressure without tightening. This restores flexibility to central banks and shifts capital flows. Countries tolerant of lower prices gain resilience. Those dependent on high prices face stress. This is not just an oil reset. It is a monetary reset. It alters how money moves through the system. It reshapes expectations, behavior, and planning horizons. Capital rotates from defense to production. Risk premiums adjust. Yet this transformation carries social and moral dimensions. Infrastructure rebuilds create jobs, but shift sovereignty.